You're about to join Niels Kostrup Larsen on a raw and honest journey into the world of systematic investing and learn about the most dependable and consistent yet often overlooked investment strategy. Welcome to the Systematic Investor Series.
Welcome back to this week's edition of the Systematic Investor Series with Jerry Parker and me, Niels Kostrup Larsen, where each week we take the pulse of the global markets through the lens of a rules-based investor. Now, for those of you who are regular listeners, our conversations are intended for you to learn and grow as rules-based investors. And if you're new to the show, we hope that today's episode will trigger your curiosity to check out the back catalog and listen to past episodes that you may have missed. Like last week's episode with Tim Pickering, who made a return to the podcast and where we really explored the area of commodities, which I thoroughly enjoyed. And if you missed that episode, I encourage you to go back and check it out right after today's episode. Jerry, always great, always a pleasure to have you on. So how are you doing? Where are you today?
Well, it's good to see you too. I'm great. Had a busy week and I'm enjoying these good markets. So that, unfortunately, determines my mood, these markets. Can you believe that? Sometimes I'll sit here and go through my charts, and when I start hitting the grain markets and it's been a good day, I'll get up and reward myself with maybe some chocolate or a glass of wine or something. So I'm highly influenced by profits and losses. Shocking to hear. Well, it just makes you human like everyone else, Jerry, which is fine. Now, I am not going to do my usual kind of market summary, partly because it's a holiday week and, there's no really big surprise out there as such, except maybe for one thing that I came across, which I thought was quite fun and interesting, and maybe something that many people, in addition to myself, was not really aware of. But, each week we talk a lot about the news relating to the US Federal Reserve, since, after all, it is the most important central bank in the world. So it would be natural to think that such an important institution would be led by highly experienced people who not only understood the global financial system, but also had some practical experience from the world at large. And then I learned this week, actually from the guest we're going to bring on Wednesday when we dive into the global macro world, which I'm doing together with Jim Kassan, and where we're going to be hosting the absolutely brilliant Dr. Ben Hunt. So anyway, Ben Hunt wrote this week this wonderful piece over at his Epsilon Theory about the experience that the Fed board members have. And it turns out that pretty much all of them have no experience outside the Federal Reserve System. A couple of them have a bit of academic experience, and a couple of them have had jobs for short periods of time in the real world. And I have to say, that really surprised me. Of course, then again, you could say maybe I shouldn't be surprised when you look at their track record of interest rate policy. And then, we often talk about how important actual experience is in the trend-following world, especially when you have to make decisions about your model and potential changes during a time of uncertainty. So I'm not sure I really feel reassured by this fact, especially because I think that we're going to see a major shift in the world. And so did you know that, Jerry, that most of these members are really just people from inside the Fed? Oh, I would have even thought worse, just political appointees. But yeah, I don't have a lot of faith. I'm like a Milton Friedman fan, so I'm more in favor of an algorithm, or let's just follow the 10-year or something crazy like that. Let's let the market decide the rates. So I'm way off the mainstream.
Well, speaking of rates, I think the other thing that I just find impossible to ignore at the moment is really what's going on in the bond markets and, what this means for investments and strategies going forward. I mean, things that has worked the last 20 years probably are the ones that are not going to work the next 10, 20 years. And when you look at charts of kind of the long-term picture of interest rates, especially if you put them in a log chart, it really looks scary in terms of the change in direction we've had. And I think this will really be kind of a driving force in what we're going to experience. But what's been on your radar, Jerry? What's been...
Well, just to comment on that, you remember not long ago, articles would come out, written by CTAs saying CTAs have made money during this with the bond market going up. And how will they do with the bond market going down? Maybe not so well. If rates go back to where they were, we won't make nearly as much because of the backwardation or the contango or something. So now look what's happening. And it's been a very profitable period with rising rates. And no one is really saying, well, if rates go back to where they were, we're all afraid they're going to go back to where they were in the 70s. I doubt if that's where those articles were headed. But it's just kind of funny that sticking to our knitting and hitting those breakouts and going with the trend, we don't really need to spend too much time on what ifs and what happened in the past.
Yeah, no, absolutely. And I do remember those articles indeed. And actually we talked about, from a trend following perspective, of course, the gift that kept giving when interest rates just continue to move down for long periods of time. But this could really be the gift that keeps giving if we're going to see trends like this, not necessarily in the same pace that we've seen so far this year, but there's a long, long way back to just anything that looks normal in terms of yield. We'll see. And in terms of trend following updates in general, I don't think it's going to come as any surprise that even this holiday shortened week has probably been pretty similar to what we've seen in March and early April, namely a very broad-based positive trending environment where most managers would have done well in adding to their tally so far this year. Energies probably stood out for most people. Obviously, nat gas up another 16% last week. I would imagine that that's high up on the leaderboard, but also grains, long-dated fixed income, currencies, I imagine, have done well. And I guess the only thing that could have been a little bit challenging this week was the shorter-dated fixed income markets, but really nothing enough to spoil the week as a whole. Now, we have a couple of questions, Jerry, to deal with, and then you brought along some great topics as well. So this is going to be a busy conversation, I'm sure. Now, I always feel a little bit awkward when someone writes in, and I'm not sure how to pronounce their name. So I'm just going to probably butcher it, but there we are. This is from Isai, I think. Isai, something like that, from Australia. Nice young man who wrote to me also on Twitter, or on LinkedIn. So very nice. So I apologize that I don't know how to pronounce your name. But anyways, he writes, I truly regard Top Traders Unplugged as the greatest podcast I've ever found, and I have been a regular listener for over 2 years. And similar to Jerry, I frequently go back to listen to episodes more than once. So obviously, when someone writes that to me, you're definitely going to get your questions aired. You'll be interested to know that despite having a background as a commercial lawyer, the insights and lessons I've learned from your podcast alone have been the catalyst for my desire to entirely change the course of my career. I am still employed at a legal firm, but have begun the process of self-education with the hope of eventually shifting my career in the direction of finance. Thanks for the impetus. I have a question relating to the often debated topic of whether to add different trading styles or stick with the trend following plus nothing. As such, perhaps it's a good conversation with Jerry or Rob, as they seem to represent either side of this debate. Jerry has often expressed his love for diversification across asset classes, geography, regions, timeframes, and model speed. It seems to me that adding different models, perhaps even models targeting convergence, there's a word, would appear to add even further diversification to a trading system. By definition, divergent and convergent models have return profiles skewed in opposite directions and appear to be quite negatively correlated. This is just by observation. I've not run a regression to that effect. It just seems common sense that adding both divergent and convergent models will only increase diversification and smoothen volatility in an equity curve. Thoughts? So, and then he ends up by saying very kindly, sorry for offending you, Jerry, but I don't think you're offended.
No, I cannot be offended, honestly. Not by honest, legitimate debate and questions. In fact, it's fun, to discuss these topics. So, well, this sounds like Oleg. You sure that wasn't Oleg under an anonymous
No, it
name?
wasn't Oleg. It wasn't Oleg. I would have definitely been able to pronounce his name. No, this is a young guy out of Australia. I have had other conversations with him on LinkedIn, as I mentioned. So someone who's, has, as he says, he's learned a lot, and he's actually kind of convinced himself that maybe a career in the area that we deal with would be more interesting than law, and who can blame him?
Oh, I wholeheartedly agree. Well, I think he summed it up quite nicely, so I won't go over. He summed up my position.
Yeah.
So I don't need to repeat any of that. So I'll try to think of something different to say. I do try to get diversification with my different entries and exits. And then, of course, I trade about 200 markets now, and all very small. So I have a broad diversification across stocks, commodities, bonds, and FX. So I'm doing something with the trend following. I'm doing as much as I can do with the trend following and not adding other strategies, because I think proper trend following should not place much emphasis on smoothness. So his underlying reason, which is almost everyone's reason for adding different strategy types, is this diversification, which I believe as a trend follower searching for these outliers is our highest calling, and not being too concerned about the smoothness, and so I don't vol target. I would probably add volatility management and just randomly taking profits off the table, or systematically taking them off, like volatility management can do for you, versus trying to add explicitly convergent strategies and trying to come up with those. There's many downsides to vol targeting and management and convergence, which we've gone over. So I don't like adding that sort of strategy. And I think overall, to tell you the truth, you'll just make less money. And so since I don't value smoothness, and that's not what trend following is all about, we value preserving capital and being consistent, making money frequently as possible, and hitting these outliers. So in my 5 things that I care about, smoothness is not there. So that's why I don't care.
Yeah, and I think that those are great points. And I think I would add to kind of where you were going, I think, with one of your comments as part of the response. And that is that it is quite natural for people, I think, to strive for this perfection. But it's just not something we want to do, because we don't really believe that you can find perfection that is robust in the long run. And I think this is one thing that people kind of have to deal with at some point in their investment strategy, and that is, are you going for perfection or are you going for robustness? And I don't think you can it can't be both. And I think we just feel that, something that has worked for so many decades is probably where we would find comfort, rather than saying, oh yeah, but maybe we can make it a little bit better. Yeah, but and then the other thing that we talked about as well, Jerry, is this term "good enough" is good enough, and I think that's the other thing that springs to mind.
I think the long-term systems, they do fairly well when the markets are choppy and there's not a lot of trends going on. You're just sort of treading water. We don't get whipsawed around very much. We hold on to positions, and sometimes they'll start drifting in our favor. But what really happens, I guess, is when we make a lot of money. In the past, since November of 2020, I'm probably up 60%. And you're just going to find a difficult time to go to my clients and say, okay, so you've made a lot of money. CTAs have done well. Your competitors have done well too. But can you guys be a little smoother? I mean, you get a hold of these big trends, you start making this money, and everything's clicking. I mean, do people say that about their S&P? that has an 8% return historically and a 50+% drawdown. It's the most consistent thing going. It's kicking the ass of all my hedge funds, all my CTAs. I just wish it was a little bit smoother. No, come on. But we have a different strategy, a different set of rules for all the rest of us, especially us poor old CTAs just trying to make a living. And can you guys just spice it up a bit? I don't really like what you do anyways. I don't like taking small profits and a 40% win rate and watching your big, huge moves slosh around and be so volatile. So can you add some other crap to it that's not going to do anything except smooth it out and make me make less money? No. Somebody has to say no, and I'm going to say it.
Yeah, absolutely. And it is true, because it's actually one of the things that I see most from investors and potential investors is when managers, CTAs, trend followers go through a difficult time, especially if it's one of those quick ones like a February of 2018 or a November of 2021. The question always comes up, but can you do something to avoid these periods? And the answer is, of course, we can. But as soon as you start doing that, as you rightly say, the long-term returns go down. And that's just not where we want to focus. So it is that I guess it's very human to think like that. But I think once you buy into the long-term and you buy into the evidence that trend followers have provided for all these decades, I think you're going to start seeing it exactly how you, Jerry, described it.
Yeah, you bring up another good point, is that I just don't like talking about Black Friday, things like Black Friday, and picking out dates and saying, hey, that was a tough time. That article that you and I talked about, CFM, I tweeted like they randomly, they just picked this period where CTAs didn't make money when the stocks went down. So what? I mean, who cares? Is this what we're supposed to do? We got to go back in our research, pick out dates that make us uncomfortable, tweak the system as if there's not going to be some cost somewhere else, and screwing up our system to fine tune and over optimize Black Friday, 2018, all these different periods where somebody wants us to do better. So we're supposed to go in and do this research and tweak these systems to solve this little problem that's so small. Once the further you get away from it, the more irrelevant it becomes. And your hardcore returns and what you're delivering to the clients starts taking center stage again because of these memories. It's like we get scarred by bad trades and bad days. Our friend Tom, we had a big debate with him recently, and he kept bringing up this silver trade. And I too have these trades that have influenced me and have made me kind of be fearful of the future to a degree and make me want to change the way I do things because I had a bad experience. And I think it's good sometimes to acknowledge you made a really big mistake and you overtraded, you didn't follow your rules. But heck, if we have a big bad period here where we have a drawdown here, it's probably not going to have anything to do with choosing bad parameters or bad systems or not doing enough research. Stuff happens, and we just can't go in and try not to have this scar us in a way that's going to permanently damage our psyche going forward and influence how we trade. We need to make those choices on how to trade from a dispassionate, science-based, research-based point of view and not too many emotions.
Exactly right. And also, one should never forget that when you look at these track records, right, those that have these big drawdowns, or should we call them the scars to stay in that terminology, those scars are there as evidence of people who survive, because I can only say that people, when you find people who don't have these scars, they usually are not around anymore. And so don't be afraid of that, so to speak. Let's move on. There's another question here, and then we'll dig into all the wonderful topics that you have. So this is from Nick. Nick writes, as always, thanks for running the show and highlighting the benefits of systematic approaches to markets. My question is around leverage and using borrowed money as part of a systematic trading approach. I wonder if there is a merit in using an investment loan to increase the size of a trading account. As far as I can see, that a trend follower / systematic investor likely only ever has a fraction of their capital at risk at any one time, and that on each trade they know the limit of their risk up until, say, 1% of capital, etc. To my mind, using borrowed money would enable a trader to grow their capital more quickly, and using a systematic approach with appropriate position sizing and risk management helps manage the quote-unquote risks. Is there something that I'm missing? I mean, just from my point of view, Nick, I would say that as a CTA, if you're looking at us, we could easily increase the risks we take because we don't, as you rightly say, we don't need all the cash to do so. The problem becomes when you live in an uncertain future and you really don't know if your next drawdown is going to be 20% or 50%. If you kind of double your leverage, it could mean that your account gets wiped out, So I think in general, we as managers probably set our risk levels to a point where we feel first and foremost that we're never going to blow up. And if you look at the various types of hedge fund strategies, I think it's pretty rare. I'd like to hear your view on this, Jerry. It's very rare that I come across a CTA that has blown up. I can think of one or two programs that have done it, but they were all like 3x versions of the main program the firms were running. They weren't the main program. How are you thinking about this?
Yeah, I mean, I think we don't want to borrow money in order to take on more undue risk. So, and the way I calculate my risk is, how many markets am I trading? So I have 200. So I'm risking about 15 basis points per trade. So I think,
per trade or per market, Jerry? Would you have more? Would you take 15 basis points on every of your subsystem entries, or is
no?
It?
All the systems are
right.
Yeah. Okay. So all 4 systems total 15 basis points. So it's really small.
Yeah.
But I don't volatility manage, so those positions can grow, because the volatility expands. So, in conjunction with looking at my performance on a daily basis and doing back testing and many years of experience, I feel like that I'm not over trading. So to borrow more money so I could trade larger and larger and larger and risk 1% or 50 basis points, I don't recommend that. So, and we do implicitly borrow using futures. And for me, I have to borrow from my prime broker when I trade the single stocks. So I am actually borrowing. There's no more single stock futures. And the primary reason that we all take advantage of futures borrowing or stock borrowing is in order to get real diversification by sizing our positions and taking bigger positions in markets that have low volatility and smaller positions in markets that have higher volatility. So we're using these tools available to us just for diversification, just for fine-tuning that risk. And like I always recommend, trade really small. So at the same time you are taking advantage of futures and borrowing through your prime broker, you have a lot of cash left over in treasury bills. So I think I've been very consistent in saying that in 1983, Rich told us the biggest mistakes you'll make is not following your rules and over trading. And I just want to raise my hand and say he was right. And I did make those mistakes. And I'm helping everyone else to encourage them not to make those mistakes. Trade small. And then once you look at yourself in the mirror and say, I am really trading too small. Okay, if you can say that, add a little bit more, but be very careful.
Yeah, and I do want to add one thing because you kind of mentioned it in your comment, and that is you're absolutely right that managers like Chesapeake, like Don, we have a lot of cash sitting on the sideline and so in the old days before the great financial crisis, the way it would normally work is people would just leave it at the bank, and then we realized during the great financial crisis, bank can actually disappear and you lose all your money. Now I'm just raising the point about treasuries. You're saying, well, do we want 80% of our money in treasuries? And of course, both your firm and the firm I work for, we use the same cash manager, because what we realize is that you can't just ignore that. We talk only about the trades, the entries, the exits, but actually there is another side to our business, and that is to be very careful with all the cash we don't use. And as you say, it's not advisable from our point of view to just double your margin by trading twice as big. That's not really something we would encourage at all. But you may have to pay attention, more attention to the treasury side of your cash than before. Now, let's jump to the tweets, so to speak, that has inspired our topics for today. And I guess the first tweet that came from you, Jerry, relates to an exchange that you had with last week's guest, which is Tim Pickering. And obviously, have known Tim for a very long time, as have I. And I knew when I had the conversation with Tim last week, as soon as he mentioned that word about adjusting position size, I knew that that's going to come up this week. And then I also thought, and you and I actually kind of discussed it a little bit before we pressed record, and that is, are people tired of listening to us talking about position sizing and volatility adjustments and all of that stuff? But actually, I think we both feel that from time to time, it is important, and maybe at the moment we're bringing it up on a regular basis, because it is a bigger topic than just whether you vol target or whether you dynamically position size or whatever. It is really at the core of how you manage money and how you allocate your portfolio. So I'm going to leave it to you to kind of dig into the parts of that comment from Tim that you want to unpack a little bit, and then we'll see where we go.
Yeah, I would just say, it's just a direct attack on what trend following is all about. And so people like Tim, who volatility management, they don't mean it as an attack on us. It's just an attack on what we have come to believe and about trend following, and that it's an improvement from their point of view. So it's going to keep coming up, because who else is attacking us? Who's saying take big losses? Who's saying like don't diversify, don't do shorts? No one. So this is the only group we can pick on. And we think we're right, and we're small, and so we're out of the mainstream. The vast majority of CTAs don't agree with Richard and me and Moritz and the people in my clubhouse. So we're like these little small Davids fighting the Goliaths, and we got nothing better to do. So I apologize. But, Rob and Tim, they cannot go a podcast without talking about me and mentioning me. And so I just take that as a compliment. And so I was particularly interested in what Tim said, and I'll just quote. He said, we adjust positions when risk-reward changes. It's the part of the longevity and part of the investor experience in terms of being involved in this asset class long-term. In other words, if we don't do it, people won't give us money. And I'm like, I've been on record as saying, probably you're right to a large degree, but then, you've got to kind of stand up and say, you crossed the line, and just because you're the client, I cannot meet your wishes on this. And so people draw the line in different places. Like if you only have 100 million under management, you can be like me and be really steadfast. But if you have billions under management from people who like volatility management, then, I don't blame them, honestly. But he does bring up this one point. We adjust positions when risk reward changes. And I think that's a bit different from what we've heard. And he goes on to say, it has nothing to do with Sharpe. It's how we extract value when risk reward changes, especially true on volatile shorts. And I thought, this is quite a bit different, because most of the vol management people, it's all about risk and reducing risk and getting the risk back to where it was. So we normalize positions based on vol at entry just to normalize the loss, to lose the same amount of money per trade, to give each trade the same number of ATRs against us to take that small loss. And so once it becomes profitable, we just let it go. And the volatility could double, triple, quadruple, but it's a profit. So we have it in a separate category, the category of let your profits run. And so we don't abide by this risk idea that risk has changed very much or at all, because our risk was the 15 or 25 basis points we were going to lose. But Tim says, well, no, it's really we're adding value, and we're able to identify that at some point we're going to make more money, and it's a profit thing when we volatility management and we're extracting this value. And so I thought, oh, that's really good that he's admitting that, because I've often accused these risk managers who do this that, well, it does do what you say, but also if the trend is sort of short-lived and kind of parabolic, then it's another way of taking off profits. And Tim admits to this and says, yeah, this is how we kind of use it. It's actually helping us make more money, not just improving our Sharpe. And so I thought, okay, I like that. I think I don't agree with it, but I think it's he's adding value to the discussion and coming clean that this is exactly how they look at it.
Yeah, no, absolutely. Yeah, no, it's good. And this is why we, sometimes more often than other times, we will come back to this, because it is fundamental to many of the things we do in terms of, quote unquote, provide the most value that we can think of to our clients, for sure. The next tweet, you almost alluded to it, but I think it's such an important point. It was a comment that you made to one of Mike Green's points that he made on a podcast, where he talked about this, that people, I think the way I understood it was that he feels that people de facto believe that just because the S&P has delivered 7 or 8% the last 100 years, that it's always going to deliver 7 or 8% for the next 100 years, so to speak. Was I picking up on the right point on that?
Exactly. I've mentioned this over the years. It's such a minority on this, even on this podcast and everywhere. It's a given. Stocks they're the primary investment. This is their track record. It's the equity premium. We can all count on this. And let's see if we can squeeze managed futures into 5 or 10%. And it's supposed to help stocks. That's, another big thing, that it's not, CTAs can't be a standalone investment. Oh no. How does it fit in with the portfolio? Is it crisis alpha? Does it help? How does it help during those periods? We read about this all the time. And this rock solid assumption under all of that is stocks are guaranteed, and we should pay attention to this 100 years history. And he goes on to say, there are so many conditional components around this very short data set that we have, that how could we possibly assume that equities have an 8% return just because of what they've done over 100 years? And this sounds like blasphemy, and it sounds like 100 years would be enough. But he's a really smart guy who agrees with me, so I'm going to tweet that. And I encourage people to go and listen to this. He goes on to say, even when we use the longest data sets, having information on the behavior of stocks from the 1870s is just not particularly useful unless you think that the world is largely an invariant place. And I don't believe that at all. So I think that with our back test of thousands of trades, entry, exit, stop loss, that we have a much more robust strategy going forward. It's rules-based strategy that we've tested versus here's what happens if you stay long the S&P for the last 100 years. That I don't think is quite in our category of reliability and robustness. And I think, along with you, that we're going to start seeing some things in the future that don't look like the past. We've lost our imagination. It's just a brilliant statement you came up with of what bad things can happen. We got a glimpse of it in 2008 with the lost decade, but that quickly went away. And now we can all go back to creating funds that are heavily invested in long S&P with managed futures on the side, or all of these ideas that every single day people, whether they're going to be successful or not, is determined by, can we trust what has happened in the last 100 years with stocks? And I don't think we can. And as you and I and Moritz have talked about, at some point in time, we've seen every country except the U.S. pretty much not have great or profitable historical returns in their country's stock markets. And I think maybe the U.S. will be next, where we may have this period where we have a prolonged bear market that wipes out at least one decade or two of positive stock returns.
Yeah, no, absolutely. And it is really interesting. And I guess it goes back to, I don't know if it's narrative, that's the right word, or just maybe how we humans operate. But as you rightly say, for most investors, it's almost a sure thing that they're going to continue to get long-term returns of 8% of equities because that's what they do. And then you look at Chesapeake with, say, a 40-year track record, done at 50-year track record almost, and they never say to us, oh, well, you've provided, this lovely double-digit return for all those decades. You're going to continue to do that. And that never comes up, right? They always suspect, oh, it must be over now. You can't continue to do that. So it's how we treat these topics very differently that is fascinating, really. Maybe a little bit on the same topic, you had an exchange with someone. I don't know the person, unfortunately, but someone who goes by the Twitter handle JP. And he was tweeting something about how to find the best investment strategy. He in the first section of his thread, he just talked about veterans might say it is not the best recommendation, but for those who somewhat know what they're doing but can't get to the next point in their experiment with markets, I would sit down and figure out what would be utterly impossible to achieve in the markets in your view. Anyways, you tweeted back. Do you want to take it from there, or?
Yeah, it was a really good tweet because it was reminding me how important it is to dream big, think big, take some time out just for thinking. I mean, I get a lot of creativity just by like walking on the beach and just having quiet time away from everything, and on the treadmill or something, and trying to just think about how to make improvements from a big scale. And I thought that that's such a good idea. And I thought, what is my dream? And, something I may think is somewhat impossible. And it got to me thinking that I seldom bring this up, but in my back testing with my long-term systems that have lots of drawdown and volatility, and I'm arguing about Sharp all the time and volatility management and the relevance of a drawdown and a big profit. My biggest profit of the year or ever, maybe Tesla, has had some big drawdowns, and it's still the biggest profit ever. And in order to get that big profit, I got to have those drawdowns. So I got to thinking, though, I keep forgetting that one of the great things about these longer-term systems is that they're highly reliable. So I tweeted back, my goal is to make money every year without taking undue risk and doing things that are not prudent. Maximum diversification, proper leverage. But and I think that that's doable, and it's possible to really have a high hit rate from a 12-month trailing return point of view. And I think that's one of the benefits that I don't always articulate, that these type of systems are very reliable. And at the end of the year, it could have been very bouncy. But I tell you what, clients really like making money frequently.
Okay, do you mind if I dig into this a little bit with you and ask you a couple of follow-up on that? Because I think that's very interesting what you say, because of course, what you're suggesting here is, wouldn't it be great if we could achieve a high level of consistency in our trend following returns? But I also think that we have many times talked about, if there's one thing that is very difficult with trend following, is to predict when it's going to make money, predict when it's going to lose money. So if there's one thing that I don't associate with trend following per se, I guess it depends on your time frame, because I do believe it is consistent in its profile, but I'm not so sure that it's that consistent on a rolling 12-month basis. But let's just say it's a great dream to have, and I share the dream. I'd love to get it. So my question to you is, okay, based on what you know now, after 40 plus years of doing it, how would you try to achieve it, so to speak? Is there any particular part of everything you've done, everything you've looked at, where you say, I think if I go down this path, and I know we talked about not doing too much research, so I'm not gonna, but if we go down this path, actually we may get to something that is more consistent?
Well, my back testing has, I chose these long-term systems because I just felt they were more robust and fewer rules. And I'm going to live with these drawdowns, and I'm going to keep telling myself that the drawdowns of big open trade profits, those drawdowns don't really matter. I'm protecting capital, but in order to do that, I'm going to trade these long-term systems, one entry, one exit, and a stop loss, and see what happens. So when I saw what happened, I stumbled onto that, hey, they're very consistent. They make money almost every year, which is just a calendar year. But if you do the trailing 12-month, which is a better measure for the future, they're in the 90% of 90%. So that is the first thing. What is the cost of vol management, of vol targeting, of paying attention to the equity curve and trying to prevent crazy drawdowns? I think it's going to be this type of consistency, so I encourage the Dunn research department to go back and update this research and see if they come up with the same thing. One entry, one exit, and a stop loss, as bad as it is from all these traditional measures, is it fairly consistent? I think the answer is yes. My research guy just did a run recently, and it was out of sight. It was better than I could have even imagined, the percentage of winning years. Number two is massive diversification. So I probably have the smallest, unfortunately, crude, heating oil, unleaded, Brent gas oil position, so the energy market. So I have a really small position there. Everyone is making more money than me in this energy move because I have so many other markets, 190 other markets, and they're not doing as well as crude. So I think, though, that my relative underperformance in that particular sector, or in March, I guess, I'm hoping that because I have it spread out further, that once again, this too will add to this more consistent approach and so I think it's totally fair to say, if you have this approach that's really long-term, that has these crazy drawdowns that no one else puts up with, could there possibly be a payoff for that? And I think the payoff is more consistency than methods that try to pay more attention to the monthly returns.
Yeah, no, I like that. And by the way, I really do completely agree that not just we as managers like consistency. I truly believe that every single investor out there would prefer a high level of consistency in the returns they get from their managers. So we're going to follow this evolution, I'm sure. Now, the next tweet came a little bit as a surprise for me, because here you are commenting on the crypto space. Someone writing in about crypto being cheap because it was 56% below its 11-year exponential growth trend. So tell me a little bit about that.
Oh, wow. I think I don't remember that one.
Okay, that's fair enough.
Yeah.
That's fair enough. So you wrote back, you commented back saying trend following alone, and then the person said, sad that it has come to truth over profits for a young entrepreneur who has built this without any backing. I'm not so sure.
Oh, yeah. I see that one now. Yeah.
Okay.
So the point of that one was, here was my friend who is trying to make a living, and he basically is just saying that he has to really be careful of how he talks about strategies he's using for his clients. And so he's like,
right,
man, it's just a bummer I can't be totally truthful and give trend following this credit. And it was his comment that something is 56% below its growth trend, and all of these drawdowns and losses and minus 56%, a lot of those things can be totally eliminated with just a simple trend approach. And so there was a couple things going on there, and I just felt sorry for this guy who is trying to run a business and protect his clients, and how better to protect them. I don't know how to protect clients and protect your capital if you're not going to have a trend following rule. I was on another podcast a few weeks ago, and the guy we're talking about machine learning and AI. And I was just saying, like, I just think the last piece of code in like machine learning needs to be, sell the breakout or buy the breakout. I mean, you got to have that in there, because things can go awry if you don't have that as your last rule. And so if you're going to have that as your last rule to save your ass when your AI or ML wasn't able to predict the future, why have that other stuff anyways? And so that we just forego all of that and just say, okay, bottom line, respect those breakouts.
Yeah, I mean, I have to say, in all of the years that I've been doing this, I have still not really come across a manager that specifically say they're doing AI machine learning that has consistently for a long period of time done well. I've seen a lot of great backtests using AI and ML. I've seen some people doing well for a short period of time. I've actually had them as a guest on the podcast many, many years ago, but they're just simply not around anymore. So I kind of like your addition to the code by the breakout at the end.
There's another good podcast that just came out, so I wasn't able to include that in my list, but Leda Braga from Systematica, I tweeted her podcast, and it was really good. And she talks about ML, machine learning, and what its shortcomings. And she's super smart, and they're super sophisticated. So I was really happy that she is skeptical about predicting as I am. So I encourage people to listen to that.
Yeah, no, absolutely. And also I listened to a bit of it, and then I got distracted. But I mean, the thing is, and I don't, it's not to pick on anyone, right? But even successful firms like her firm, and I think this is important for people to understand. Here you have one of the most successful firms in our industry, right? And with a fantastic reputation. And later talks about how fun it is to do these type of sort of systematic trend following strategies. But even them had a 10-year period where they made no money. 10 years, that's a long time. So we just have to always, I think, get back to this setting of expectations that as much as we believe that this is a great strategy in the long run, the long run can be very long from time to time. But that doesn't mean that anything is wrong with the system as such, other than, back to your point, it would be great if we could achieve higher consistency, of course.
Another thing to talk about later with Richard probably and Rob, because I just pretend to know something about backtesting and math, but they're the ones who really know it. And so she made this point that I thought was somewhat fascinating, and I'll just read it. And I can't really discuss it,
Sure.
But it's really fascinating. And she goes, the trend following signal is too weak to say mathematically that it's broken. Even many years of difficult performance will not signify that it's broken. The length of underperformance was not mathematically meaningful. So I thought, oh, wow. So we can't even, because people ask us a lot on this podcast, when do you know that it'll stop working, your system or trend following in general? And she's sort of saying, I think she's more of a quant person than me, you can't even make those inferences because it's too weak.
Right.
I'm like, oh, fantastic, because I actually embrace this weakness, and the signals are too weak, and you can't get enough evidence. So here we are trading something. It's incredibly profitable, and it's weak. And we sort of feel that it's weak a lot of times because we don't make money, and people criticize it. But then we get to rely upon its weakness and say to ourselves, but it's so weak that we can't even say it's broke. I love that. I mean,
yeah, that is.
So she's just
funny.
so good and passionate, and it was refreshing. So hit my Twitter and you'll see that. It's really good.
Good. Speaking of Twitter, another one closer to home, Now we're into a couple of exchanges with our own Rich about divergent regimes and how they may last a lot longer this time than a lot of people think, which is obviously also part of my own thesis here. And that we have seen the end of the carry regime. That's certainly, in my view, what's coming. And we have this new era of trend following, perhaps even like the 70s, the 80s, and the 90s. So do you want to take it from here? The first tweet that you got into was about positions. I think Rich and I had talked about the fact that a lot of people think we're making money from the war in Ukraine, but actually all of our positions in energies and in other parts of the commodity space were initiated way before there was even a Russian troop next to the Ukrainian border. So I don't know where you want to go with this, but I think that was the context.
Yeah, so many places to go. This was a great podcast with you and Rich, and you said a lot of things that I liked, and of course Rich did too. So, but I think it just reminded me that. He says, be prepared to ride these trends for a long time. And I think that's our human psychology is just always telling us, be very fearful of giving back these profits when we should be very hopeful that they'll keep going. And that's what the back test says too. The back test says, try to use these longer term parameters, these loose pants, where all these scenarios can fit underneath and you don't get bounced out of this trend. So many things can happen and just hold on. And the charts can look very ugly. But I think, and another thing people ask us is long-term, medium-term, short-term, what should I do? And I think the podcast that you had about exogenous, endogenous, go back and listen to those, and you come to this conclusion, or at least I did, that, okay, that's why we want to do long-term, because exogenous trends that last a long time, exogenous events drive these long-term trends that can last for long periods of time. So, and the backtest kind of supports that thesis. So I was always encouraged, again, not just that I'm looking at this backtest, so I choose my parameters, but from that podcast and others, it seems that makes a lot of sense, that we do see a lot of these long-term trends, that these trends that last for long periods of time, multiple years, and we should try to hang in there. I'm still short. I'm going to give you this. You're going to hate this because I have listened to you say, oh yeah, you said something like a few months ago. It was kind of like such and such market is down like 50%, Moderna, and how can you still be long? And I was thinking well, as bad as it sounds, and as much as I agree with you, you just have to stay long until your exit gets hit. And so this is one of the frustrating things about breakouts, which are just the best. In every way, they're the best, theoretically and in the back test. But when you get out of this at the 100-day low or the 150-day low, what percentage is it? It could be any percentage. I mean, it could just be 5, it could be 50. And so you really can't say, well, who's going to stay in this trade minus 60% retracement? Well, if it hasn't hit my trailing stop yet, I would be one of those people. And so these charts just look horrible. But so does that natural gas chart, Niels. Mm-hmm. The one that just made new equity highs. It had a monster drawdown. And I'll tell you right now, because I didn't get out, I know I handled that trade better than anybody. Mm. Because if you got out for any reason, you didn't make the money that I've made, you had to resize at the highs. So all I'm saying is sometimes this silly looking way, it does work, and it works the best. And that's what the back test says. Because I am still short ruble. I'm still in ruble and I'm still short, and it's given up all of its profit because simply it hasn't hit my trailing stop, which is embarrassing because it certainly doesn't look like it in a downtrend. But that's not our litmus test. Our litmus test is we have these parameters, these entries and exits. Are we going to follow them irrespective of what the chart looks like? And I'm trying my best to do that.
And that is, of course, the absolute correct answer that you just gave there. And I don't, of course, would suggest that when I probably post that question about who's still in this trade is, of course, trend followers would be, if, as you say, if the stop hasn't been hit. By the way, speaking of ruble, I'm kind of surprised that it's still trading as a market. I thought that all these sanctions would make it impossible to trade ruble because I think I heard from I saw some headlines, for example, people who had exposure to the Russian equity markets, that the rules were that they had to mark them at zero, even though they theoretically has some value, but because it was Russian, they had to mark it as zero. I don't know which rules they were exactly, but I think some of the big I don't know if there was auditors or administrators implementing rules relating to Russia had forced some funds to do that. But I guess you're trading it on the CME. Is that where it's trading?
That's right. And,
okay.
I was short. So Rich, a few months ago, or within the past year, 6 months, 12 months ago, he gave me permission to trade stock indices. And he and I talked about it, and I said, okay, I'm going to put short stock indices back on my portfolio, so I only short them.
Right.
And go long the single stocks, short single stocks as well, and short indices. And so I have a decent position short indices now, and I picked up some ETFs. So I ventured off into ETF land on some of the country, ETFs. And,
right. Yeah.
Because the futures don't exist in some of these countries. And so I got short Russia. And then I got lucky because as it was crashing, I got out before it stopped trading. So that one, I don't know if I would still technically be short, kind of like nickel.
Okay.
It reminds me of nickel. And so what's going to happen?
But you got out for other reasons, right? Not because of a trading stop. You got out for other reasons of that trade.
Exactly.
Of the Russian.
And so
Okay.
I'm still short the ruble, and I have been reading articles that it's very illiquid. But it's a small position, so hopefully it works out.
Okay, cool. Then you shared, and I have to thank you for doing this because I know you mentioned it before, but I think it's fantastic that you do it. You shared this 60-second clip from YouTube, I think, from my conversation with Rich as well. Probably the same conversation as before. I don't even know how to do it myself. I probably should, but I don't know. But anyways, you shared this clip where he talked about geometric or the geometry of classic trend following. He talks about this equity curve and I have to say, I'm not so sure. Either Rich and I didn't quite fully understand each other when I explained my side of things, but I'm not so sure I fully agree with Rich on this, that you know, because my argument was that if you can stay a little bit closer to your equity high, not going into so deep drawdowns, your compounding effect will actually help you over time. And I kind of felt that Rich was saying, no, it doesn't really matter because there's some geometric stuff going on inside the equity curve. And I'm not sure I fully understood it. I'll have to ask him again next time he's on. But I still think deep down that there is definitely some effect of deep drawdowns in terms of the long-term compounding growth of your overall capital. But anyways, you tweeted part of that conversation. And
this was a very good interaction. I mean, I learned so much from him and you were asking him all the right stuff. And I mean, we need to make him tell us more about this and answer our questions. I ask him questions sometimes. He doesn't really answer them, but I just keep asking them. He's just got so much knowledge, and I think it's hard for him to anticipate what the heck I'm asking. But and then this clip thing, as I said in one of the tweets, it's just my editing, copy paste of what he says wouldn't do it. I had to figure out how this clip works, and it was really good. And so you asked him, and you gave him your opinion, which you just stated, and he said no. Basically, my interpretation was, he's like, yes, you're correct. When you have these drawdowns, there is a negative impact. But But these outliers and letting these profits run, they overwhelm the drawdown. So don't cut the drawdown. Don't cut the possibility of this outlier profit in order to limit the drawdown. Take the full drawdown, because these big outliers will overwhelm all those drawdowns. And I thought, man, and that's what he called the geometry of trend following. And I thought, this is brilliant. And I thought, this is just the best thing. And another thing that I tried to ask him and get him to explain to me was my comment about that tweet, which is bumpy and lumpy creates more wealth with less risk. And I think he's on board with that, but he and I have not hammered that, because when we talk to these CTAs that vol manage, they talk about less risk. And what Rich is saying is, no. We have less risk by letting these trends go. And I think that is brilliant as well. That just needs to be more unpacked by him, more explanation. But I think that's where he's headed, is that ironically, we have more risk when we have more volatility, because these crazy outlier moves give us so much profit that if we don't have them, later on we'll face bigger drawdowns and less profit. So it's great stuff. Yeah.
Yeah. And as we move down the list of tweets, there's only a couple of left here, and but there's one here that is from another friend of ours, namely Mark Resepsinski, and from his blog. I think this is where you found it. I think it's something about inertia of success, as far as I can tell. So do you remember where you were heading with that?
Yeah, this was a really great one from Mark. I'd probably tweet his articles more than anyone. I mean, he is just consistently great, especially if he mentions trend following. Then I'm all over top of that. But he just has a very unique way of putting it together and helping me understand deeper what's going on in the markets. And I really like this part where he said, believing in your record as a measure of future success is dangerous. Now, on one hand, we're not supposed to say, as you remind us, we're not supposed to talk about future results, past results as an indication of the future. I believe you agree we're not supposed to tell people we're going to make 50% per year over the next 5 years.
Or like Kathy Wood did the other day.
Yeah, that's right. Some of these tweets...
Yeah. Well, let me just interact that she doesn't rely on past performance, because her past performance is 25%, and then she comes out saying she's going to do 50% in the next 5 years. Crazy
That's right.
stuff.
So another thing, we believe in all those things, but another thing Rich has said, which I think is another area to keep exploring, is he says something like, the best evidence of success and risk management is the long-term track record. He's kind of saying, by the mere fact that Dunn has survived, they know how to protect your capital. And one thing that frustrates me is spreadsheet calculations. Sharp, Marr, Sortino, Serenity, any of them, they're from a spreadsheet. What are we supposed to get from those? What are we actually going to use them for? They're shortcuts for, are you going to survive? Or they should be. But however, some of the best track records out there have bad Sharpe ratios and bad Sortinos and maybe bad other types of ratios, but they've been around for 30 and 40 and 50 years. So, okay, but now we're saying you can't believe in this track record. And so I think to some degree, we're saying like, it's great what's happened in the past, but you have to be paranoid every day and be aware of what it takes to succeed every day going forward. And don't just rely upon what you've done and your previous success. So I think it's a little bit hard to understand or contradictory, but I really like this whole idea of, I like the past sometimes, but then I'm not going to relax and not be paranoid and not be vigilant about what it takes to succeed just because of the past.
And by the way, speaking of that, don't you think that every single strategy, the longer they run, the worse their stats will be? I mean, isn't that just inevitable that if you have a 10-year track record compared to a 20-year track record, most likely the 20-year track record would have a lower Sharpe and have a lower this, that, and the other? Isn't that just what to be expected?
Maybe. I don't know. I would defer to others.
The professor.
Professors on
right.
that one, yeah. Yeah.
Okay, fair enough. Well, let's defer to our final topic for today, which is from another brilliant professor, so to speak, certainly professor of writing great blog posts, and that is, of course, Morgan Housel, who published an article that you tweeted about called Deep Roots. This is from late March. So tell me a little bit about that. I have an idea of what it's about, but I would love to hear your thoughts on this particular post that you found interesting.
Oh, yeah. So he's the second most often person I tweet. He's a very talented guy and probably is more of a value stock guy, but just like Howard Marks or other really famous managers, they have a lot of the same core beliefs. And he goes on to say the craziest events, good and bad, happened because little events, each of which was easy to ignore, compounded. The range of possible outcomes of what might be achievable can explode. And Rich talks about that a lot, about the back test is just one possible event that occurred, but then going forward, the possibility of different things happening is infinite almost. And this just is another reason that we all want to trend follow, because we really can't predict these little events, and we don't know how they're going to compound, what's going to happen, and what the range of possible outcomes are. So just following the prices, these weak signals, I love weak signals. I'm going to start using that more and more. That's our best idea of protecting our capital and making a fair return.
Absolutely. Well, let's finish on that high note, so to speak. Let me just quickly run through some numbers because it is, although it has been a shortened week, performance has still been pretty spectacular. I think so far in April, BTOP 50 is up 3.75%, up 13.2% for the year. SocGen CTA index up 4.08%, up 17.4% for the year. SocGen Trend Index, hard to keep up 5% so far, or 5.2% actually, up 23.8% so far this year. And the SocGen CTA, Short-Term Traders Index, up 1.8% and up 7.46%. By the way, did you know that the SocGen Trend Index just had its, I think, the third best quarterly return, calendar quarter return ever in its history? That was Q1. And the broader index, the SocGen CTA index, it was the second best quarterly calendar quarter index, actually. So pretty strong start.
Awesome.
Yeah. The trend barometer is also still pretty strong, up at a level of 66. So it's enjoying a good 2022 on a consistent basis. In the other part, in the traditional world, MSCI World Index is down 3.06% in April, down 8.4% so far this year. And the World Government Bond Index having a rough year, down 2.17% so far in April and down 8% so far this year, which I think must be one of the worst starts to any calendar year in its history. Anyways, we appreciate everyone listening and tuning in every week. If you feel you're getting some value from our conversations, please share and please rate and review as usual on Spotify and on iTunes. Next week, I'm joined by Alan. Make sure you send your questions in advance. You can email them to info@toptradersunplugged.com, and we'll do our best to get them answers for you next week. And by the way, do tune in to Wednesday, the new Wednesday episodes. Alan just wrapped up his first season of great conversations with some of the top CIOs in the world. And I especially enjoyed also the last one he did with Hugo from Rothschilds. But starting on Wednesday, we're going to move on to global macro as a topic. And I'm doing that with Jem Kassan, who many of you know already. So that's going to be a fantastic series. From Jerry and me, thanks ever so much for listening. Until next time, take care of yourself and take care of each other.
Thanks for listening to the Systematic Investor podcast series. If you enjoy this series, go on over to iTunes and leave an honest rating and review. And be sure to listen to all the other episodes from Top Traders Unplugged. If you have questions about systematic investing, send us an email with the word question in the subject line to info@toptradersunplugged.com and we'll try to get it on the show. And remember, all the discussion that we have about investment performance is about the past, and past performance does not guarantee or even infer anything about future performance. Also understand that there's a significant risk of financial loss with all investment strategies, and you need to request and understand the specific risks from the investment manager about their products before you make investment decisions. Thanks for spending some of your valuable time with us, and we'll see you on the next episode of The Systematic Investor.